Yeah.
Eat it. You can't beat it.
Absolutely.
Okay, folks, so I'm literally going to spend 2 minutes on SPY. I don't think there's any point in dwelling on SPY too much. It keeps grinding higher. So we've spoken about this. I felt this would grind to 6,500 by the end of the year. We're here already. But I do also believe that we're going to get some sort of a correction at some stage. What the catalyst is for that or when that happens, I don't know. Nvidia's earnings last night, I thought might cause some sort of a sell-off. But if we go into the Mag 7 stocks here, they actually bet their expectations, right? And if you look at them in pre-market, I think that they're only down slightly. I think it's 1% or something. But they bet their expectations, but there was a big question mark over the rate of growth, which is starting to fall off. So I suppose analysts and everybody, pundits, are used to seeing Nvidia smash their earnings. So it's no longer good enough for them to beat their earnings. They got to smash them and then raise guidance going forward. But everything was ex-China as well, though, in terms of their earnings. So if China gets thrown back into the mix, it's positive for them. So I thought potentially that could have been a catalyst if they came in and disappointed the market. It's still a possibility. It's early days yet. We're still an hour and a half from the open, and it wouldn't surprise me by the end of the day to see this either up big or down big, to be quite honest. It'll go either way, because I've listened to so many analysts talking about Nvidia and seeing it in different lights. So back to kind of relating that back to the S&P, I was probably hoping that might be just the catalyst for a bit of a shakeout in it. But I don't know if you remember, I think it must be 2 years ago now at this stage, there was an Irish company that built this algorithm that basically looks at technical signals in the market and stuff like that. But Brendan shared a report with me during the week that they sent on to him, that all their signals are screaming sell at the minute for the broad stock market indices. Now, there's no time frame on that. That signal has been given since the very, very beginning of August. So if you think about it, that's the beginning of August. And the market has gone up quite a bit since then. So it hasn't been right so far, but they're still screaming sell. So we just thought I'd throw that into the mix for what it's worth. But my own view is, I also believe that, by the way, not from necessarily a massive technical signal or anything like that. I just think, you know, we've risen so quickly from this low here up to this high, I suppose. You can see that it's actually the rate of acceleration is starting to dwindle off. It's not as powerful a move anymore. You can nearly see it kind of playing itself out. And I think you probably need to come back a bit in order to bring fresh capital in to the market as such. So I just think in the natural moves of the market, this is probably likely to come back at some stage. When, I have no idea. But September is historically that weaker month for the market. And my hope is that this happens throughout September. We get down below 6,000. And I think at that stage, absent any further weakness in the US economy or anything that could throw a spanner in the works, I think it's going to be an opportunity for you to buy, because I do think we'll come up and take this high out again. So let's assume, I'm not saying this is the case, let's assume this is the high of the market right now, and maybe throughout the month of September we start winding our way down. Hopefully that's the case. I'm not, obviously I have no crystal ball here. That's what I'm hoping for. If that's the case, I think then from October to December roughly, you see this high getting retested again and possibly even taken out. And that would lead to a 10% return if it just met the high again, and more if it got taken out. And again, I don't see any reason why it shouldn't do that. But I think we need to see some sort of a correction. There's no real advantage buying in here at this level, in my view. So therefore, the ratio put spreads that we've spoken about so many times before, and we've done so successfully, that's on the cards again. But I'm not prepared to put them on right now. They're not on the table. You can see SPY is at 646. I want SPY down at 620 to 625, and then I'll apply the 610 600 ratio put spread for September, and then I will take the assignment if we do lucky enough to get assigned. So that's the plan with SPY. just didn't want to spend too long on it. Nothing we can really do here, in my view. I wouldn't put a ratio put spread on here at all. It's just the premiums aren't there, and you would have to come way up the strikes here, and I think it's not worth that risk in my view. Okay, so have you any questions on SPY at all?
The only one that I had looked at there was the 630, 620 out to, you were taking in, I think, when I looked at it last, maybe a couple of days ago, about 120 or something.
Okay, yeah, yeah, that's not enough premium for me, Michael, and I don't want my average price break even up up to 600 if possible, you know. So from just personally from myself, that trade wouldn't work for me. I'm not saying it's not going to work, but it wouldn't be my cup of tea.
Yeah, that's fair. That's fine.
I'm just looking at it now. I'll have a quick look at the prices. So you're paying 323 at the 630, and at the 620, you're getting in 2 times 211. So you're getting basically in $100 net credit.
Oh, it's dropped. It's dropped.
Yeah. So I personally, what I would do, Michael, fingers crossed, we get some sort of a drop.
Yeah.
And if it's that 620 level, then I'd probably do the 610, 600, and you're probably going to take in a credit of over $200 at that stage if that happens. Now, obviously, it depends on the time frame. You know, if it happens the week before September the 19th, you're not going to get that premium in. But if it happens next week, for example, you will. You know.
Yeah. Yeah.
So I think we're better off being patient there.
Absolutely.
Okay, so just on yesterday's trade, TLT, so you can see, I just want to go to yesterday's trade. So when I put that trade on, TLT was down here at about 86.10, right? So you can see it recovered quite a bit. It closed up at 86.65. So if you think about it, we sold the $87 puts yesterday. Or for people outside of the EU, you bought TLT outright at probably around 86.10. So you're up quite a lot there. You're up 55 cents on an $86 stock straight away, which is just slightly less than 1%. And you can see it's up further again in the pre-market. It's up to 86.80 at the moment. It was up over 87 at one stage, by the way, in the pre-market. So you're up the guts of 70 cents, which is almost 1% in a day. So for those of you who sold the puts, which expire tomorrow, there's nothing for you to do. I would let that trade run out. If TLT jumps and goes on up today and bursts through 87, just leave it alone. Take it as another win. I mean, 3 weeks or the last 4 weeks, you've done 3 of these trades, and they've averaged just under 1% each time. So you're doing quite well out of it. And then we'll just reapply it again when TLT comes back down to 86, if it does so. If you get assigned, however, tomorrow, I would just hold on to the stock. And then probably if it does get to 88, for example, we might have a decision to make at that stage whether we want to do a short-term sale, wait for a pullback, and then apply that short put strategy again. But that will be dictated by what's going on in the US economy at that moment in time and what the Fed are saying. We already know that the Fed have kind of teed up the potential for a rate cut, but we've a bit of economic data to come out yet before they actually follow through on that. And for that reason, I think interest rates, and let's go to the 10-year bond to look at the interest rates, I think these interest rates are going to go sideways. So for me, you're probably going to see interest rates in the short term I'm talking about now. So when I say the short term, maybe between now and the end of September, that's what I'm talking about. I think you're probably going to see this go between something as low down here as 4.2% up to 4.4%. I think we're possibly going to stay in this little range here for a while until the Fed actually make their move. And as you can see, we're starting to come down to the bottom end of that range. And for that reason, for people who want to actively trade, so this is for people who want to actively trade, I would probably look at and maybe offloading TLT if it gets up, because if that happens, it gets to 4.2. There's a good chance TLT will be up at 88 at that stage. And then it's a decision to make. Do I take that profit off the table, walk away? There's nothing wrong, by the way, in taking a longer term view here. So for those of you who don't fancy buying in and out and the hassle it brings, well, then the longer term view is, in my opinion, I think we're going to see interest rates down between 3 and 4% over a period of time over the next number of years. I do think Donald Trump's going to get his way, and that will equal TLT being in the mid-90s, even close to 100. So if you wanted to play the longer game and wait, but just be prepared for this. If you're going to do that on a longer term basis, just be prepared to see it kind of up a couple of weeks, down a couple of weeks, up a couple of weeks, down a couple of weeks, until the Fed start making their move. So, you know, you've two trains of thought here. People who want to book profits in, and we've pretty much done it in the EU through selling puts in the money so far. That's fine. Take the profits off the table, walk away. Every time it comes back to 86, keep doing it. For people who have a longer term view on TLT and want to take a longer term strategy, nothing wrong with holding this. It'll probably get to the mid-90s at some stage. In the interim, though, you're going to see it up at 88 and then back down at 86 until we see the Fed move. So I hope that's clear, folks. Have you any questions on that? Any clarification required?
No.
No. Okay.
David here, quick one for you if you don't mind. I'm much silly. What you mentioned the 10-year there. What's influencing the price of the rates according the rates on that? So you said there might be variations in the 10-year. What's influencing that, causing that price to be, or that rate to be up and down? I'm not sure if I'm phrasing the question correctly. I'm just curious as to why 1 minute it is at 4.5, the next is at 4.2. You know what I mean? So, what do you can give me 2 minutes of an explanation of that, please?
Yeah, no problem at all. So the first thing I'd say there, Stephen, is just a couple of things, right? It's usually economic data that influences. So, for example, any inflation data that comes out. So if inflation data is higher than expected, usually interest rates go up because the likelihood then of the Fed cutting rates is disintegrated. You also have, could be jobs data, for example, will have an influence on this as well. So if jobs data is really, really strong, the likelihood of the Fed cutting rates is low as well. The same in pretty much any economic data that's positive actually will have a positive impact on interest rates, and vice versa. So economic data is very, very important, but you've also got other factors at play as well. You've got the US government themselves, or the US Treasury. Don't forget, we went through a period of buying our own bonds and all of that type of stuff. That's no longer the case, but that was the case. So that can have an impact. I just want to give you all of the things. So right now it's economic data and Donald Trump. Pretty much that's, Donald Trump is going after Fed governors. He's trying to sack one. He's trying to basically fill the board with people who are pro-interest rate cuts. So that will have an impact. And the more that board gets weighed to one direction, interest rates are going to react accordingly as well. But also another thing you've got to bear in mind as well, it's the demand for the bond too. So for example, if let's say there's a terrible report out on NVIDIA last night and it spooked the stock market, right? All of a sudden you're going to see the demand to rush in to buy US government bonds because it's considered risk-free. So the yield will come down. The more people who want US debt, for example, the US government don't have to pay them as much interest. So there's a myriad of factors here. You've got demand, supply. It always boils down to supply and demand. What can impact supply and demand? Usually it's the macroeconomic data, but it also can be adverse impacts on other asset classes. So for example, stocks. If stocks all of a sudden start diving, you're probably going to see interest rates come down in that scenario as well, because everybody's flooding in, they're selling their stocks, they're buying up the safer asset. So macroeconomic data, Donald Trump at the moment, are the two key drivers. And then obviously, if we had some sort of a wobble in stocks, I think you'd see the 10-year yield go down as well.
Understood. Okay, so all these factors, that I'm sure more influence it, and what determines the prices themselves is the market. The market will determine. Will say it's worth it. We reckon it's going to be that, you know,
Yeah.
4 point whatever it is, five something. Am I got that right? And did I understand that correctly?
Yeah, it all boils down to supply and demand, Stephen. So, for example, um, if, just I'm just going to get you. Yeah. So, if you look at, for example, if you look at the reaction in bond yields, when Donald Trump got into power and everything like that, and all of a sudden it was tariff. You could see here, bond yields start shooting up here, in the anticipation that inflation is going to go nuts. So that's the reaction. So the data at that point in time wasn't bad for inflation, but the expectation of the inflation, so I'm pointing here to when the tariffs start first getting announced, you're all of a sudden it was, okay, investors started going, you know what, the US government are going to have to pay us more to start taking their debt. So this demand was obviously low at this stage because the anticipation was that interest rates are going to have to rise to combat this inflation. So the US government had to start paying more to people in order to take on US debt. People were dumping the US debt at that stage. So that's just something to be aware of in the supply and demand side of things. So there's a number of factors at play, and it's like stocks. It's the anticipation of future profits as such, and it's the same with bonds. It's the anticipation of the future profits of the US government, really. If you can look at it that way, think of it like a stock even. How profitable is the US economy going to be in 3, 6, 12 months' time? And bond yields will start reacting now in accordance with that, Investors will start moving early.
Okay. So expectation, anticipation, sentiment.
Correct.
No different than anything else. Okay,
Absolutely.
thank you.
And that's where everybody is at the minute. Everybody's scratching their heads going, what's he going to do next? So it's really, really difficult to plan, for companies to plan. We know he's targeted individual companies, he's targeted industries. He's now having to go with India again because India are talking to China. So there's, it's what's going to happen next. But so far, the stock market couldn't care less. The market is happy with what's going on, and I suppose right now corporate profits are really, really strong, and that's what's driving stock prices. So I don't think that's going to change, in my own opinion, because I don't think, if you look at the composition, by the way, of the S&P 500, and before I forget, one thing to mention is Walgreens is getting removed from the S&P 500 because it's been taken private, and it's been replaced by Interactive Brokers. So, just think of the makeup of the S&P 500. It's constantly being regurgitated, and the index is made up of 500 quality companies as such. And as one company becomes unfavorable, it's replaced with another. So it's kind of almost built to go up over a period of time. And the shape and makeup of the S&P 500 has changed dramatically in the last 20 years. So technology used to be less than 10% of the makeup of the S&P 500. It now accounts for about 35% of the value of the S&P 500. So it's significant. And I think that's going to grow further. Because we're coming into this AI phase, folks, and I think companies themselves don't even know how they're going to monetize it. And what I'm talking about is what's it going to lead to down the line? Like, what company right now we have never heard of is going to be the next NVIDIA, $1 trillion company? I think you're going to see lots of them in different spaces in technology over the next 10, 15 years. I think the rate of change is going to just get faster now. And we've got quantum computing as well coming down the tracks at us. So for that reason, I think technology is going to continue to increase its weighting in the S&P 500. And I think you're going to see a lot of upstarts coming along that are going to, I suppose, keep this technical revolution on track as such. So for that reason, I think pullbacks are exactly going to be that in the market. I think they're just going to be pullbacks. And I think we pretty much have to buy into them. That's my personal opinion on it. there's lots of people out there will totally disagree with me on it, who are extremely bearish right now. There's loads. You think this market is going to get its comeuppance. But my own view is the profitability there and the growth is still there. And I think efficiencies are going to continue to be made through AI in companies, and it's going to lead to further growth. So I think the only thing that can derail this is possibly some stupid decision out of the White House, or maybe the decisions are so bad and the uncertainty becomes so great, unemployment grows at a rapid pace. And that type of stuff is, but right now there's no sign of it. So we can't say that's going to happen. So for me, a pullback is to be bought into that Christmas period. The TLT trade, just to summarize that. So for anyone who sold puts yesterday, if you don't get a sign tomorrow, so be it. If you do get a sign, happy days, take the stock. And then a decision is for everybody will be, if it hits 88, and the reason I'm saying 88, you can see it's a clear resistance point. Do we sell in the short term with a view to, going back into it again if it drops back to 86? And I think this is what's going to happen until we see the Fed actually cut rates, okay?
Yeah.
Moving on to natural gas there, I just wanted to, so the artificial bump, you can see the contract switch over on Wednesday. That's yesterday. Now, it was up as well. So a great way again, just let's click into the October contract. You can see it actually was up yesterday. We're actually down today if you looked at the October contract on its own, and it's still in this downtrend. So still not ready to pull the trigger on natural gas, although it's getting closer and closer all the time to where we want it to be to start taking a position in it. So right now we're just still in the monitoring phase there. I know everybody wants to get going on it, but I just, this thing is so volatile, guys. The closer this gets to 2, the better for us. And if it means we miss out on a trade, so be it. You don't want to be on this when it collapses. If it does collapse 20-30% from here, you're just managing it more on the way back up. So we're better off being safe than sorry here, I think. Some stocks, obviously, we've been following for quite a while now. Let's look at, Veolia, for example. This is a French stock. There's turmoil in French politics again. But this stock, just so you know, there are water waste treatments, water plant treatments. I like this because of potentially the rebuilds that could be happening in Gaza, in Ukraine, and other areas. That's why this stock is one that was on my watch list. I had said I'd much prefer it closer to 28, even 27 euro before we start buying. And our decision to hold has been paid off. It's had quite a correction here. So if I look at our dividend yield there now, you can see at the moment it's 4.94%. So this is getting quite attractive down at these levels, even from the dividend point of view alone. So that was, if you were looking for a buy and hold stock, now buy and hold, you're talking 3 years type stuff. Veolia is starting to tick into that box. Whilst it's made this little shakeout here, we'll monitor it further. But that's getting interesting now. And then the other one, of course, was Kingspan. Again, I was concerned about this downtrend, this series of lower highs that I kind of drew weeks, maybe months ago now at this stage. And so far we've been right to hold our wish. So I think, you know what, again, some people may have bought in at 70 euro. That's fine. You can average in at 65 here. So if you've already bought into Kingspan, I wouldn't be buying yet. I'd wait, see that we get down to 65 euro. But I think down at these levels, then it's worth a look down there. So that's Kingspan and Veolia. But I'm not really a fan, as you can gather, buying stocks. If I'm not going to buy the index now, buying individual stocks is tricky, in my opinion. I'd much rather just wait and just trade the hell out of the S&P 500, TLT, and natural gas, to be honest with you. But if you are buy and hold and you are looking for stocks, maybe Veolia, you're going to hold that for a period of time. You're getting a 5% dividend every year. And they do have a track record of increasing the dividend too. So, 140, 125, if you look, 112. So this is a European-based stock. they tend to pay the dividends just once a year. It's not like the US listed stocks, which is every quarter, just so you know.
Do you buy that on the US market or in the European?
No, I would buy it on the European markets, just to avoid, any currency risk. The downside of the European markets obviously is, Michael, you have the stamp duty.
Yeah.
So that's the only downside. But I think just to keep it, and as well as that, by the way, on the dividend as well, the US withholding tax isn't taken. When you buy a US listed company, there's a withholding tax, a dividend withholding tax they take off you at source as well, which dilutes your dividend down. And so you're not liable to that either. So I would, if you're going to go with Veolia, definitely on the European markets.
Would that be the London market or the?
It's France. It's the French stock exchange.
Oh,
You'll find in the whole European market, Michael, is connected by Euronext anyway.
Yeah.
So you'll see it's fairly straightforward. If I was to go into Interactive Brokers here, actually, I'll pretend I'm going to buy it here. Just show you here, VIE. When you hit enter, you can see here it is. This is the way it'll look, and you just click on stock, and that's it. So it says SBF here. So if any of you are looking to buy it through Interactive Brokers, that's what it looks like there. And it's in euros, so you won't have any currency exposure either for people who are based in the Eurozone. Okay. So yeah, so kind of that's that on that. Yeah, and that's pretty much what I wanted to kind of, I know it's a short and sweet one this week, but really wanted to just focus in on the three areas right now. SPY when the time is right, TLT we have a trade on, and natural gas. We just have to keep an eye on that one. That might be a slow burner, but I think, yeah, that's the strategy for now. And if you really wanted to buy something, I kind of like the looks of these guys down here, Veolia and Kingspan. Yeah, and that's kind of all I have for now. I'll have a quick look at the currencies. So somebody was asking me about currencies during the week there. I think it's very difficult to call on both of these. So the UK have a lot going on at the minute. Their bond yields are spiraling out too. So if you looked at the British pound versus the US dollar, gauging, if you can see this is right in the middle of kind of let's say a support area and a resistance area. So calling which way this is going to go, in my view, is next to impossible. So I don't think that's even tradable at the moment. On the euro dollar front, I think eventually you'll see a stronger dollar over time, but it wouldn't surprise me in the short term to see this go to 120. I do think Trump potentially is going to get his way, and I do think you're going to see maybe that make its way and have another retest at the 118 level, and possibly go to 120. But I do think thereafter, once that's all said and done, I think there's a potential of that making its way all the way back to 110, 112 at some stage over the next couple of years. But again, it's very difficult to trade this in any specific way. So right now, I think we might lean towards a weaker dollar, towards the 120 level. Short term, impossible to call. Longer term, I think we end up back down here again. So any questions, guys? Any stocks you want me to cover?
Only comment I have was I got greedy yesterday and didn't get assigned or didn't get the short puts on TLT. When is the next Fed meeting?
Great question. Find out now. September, isn't it?
Yes.
It's usually September 16th to 17th of September.
So it's before the September expiry on the options.
No, we were only going out 2 days, Michael.
Oh yeah, I know with the TLT, yes, yeah.
Yeah. So it didn't matter really, Yeah, but you have lots of data coming out before then.
Yeah.
Anyway, that's going to move that interest rate up and down. So you'll get another chance at that, Michael. So I wouldn't chase it today. Somebody else missed it as well. I wouldn't chase it, but yeah, it's one of those. I think that the rule of thumb for now, just in the very, very short term, is if it gets to the low 86 level, do the short put strategy out for a day or two, and use the 87 strike, and then if it gets to 88, then close out of it. That's for your short-term people looking to lock in profits. Okay?
Yeah, I got greedy and I looked for 95 on it yesterday. So
oh well, yeah. Well, that's no harm in doing that either. That's a good discipline to have as well, Michael.
yeah.
Okay. Yeah, and just on that, guys, if you've got significant winners in your account, and even some losers, keep checking in with Equity Scan to see the target price on them, and see, is it worth holding on to them? Because if we do get a bit of a shakeout in the market, I don't think anything gets spared. I think pretty much everything goes down. So if you're overweight in equities now, maybe lock in some gains on some of the stocks. But so before everyone asks me then about Google, unless you were stuck, I'd hold on to it. I think this is something you can hold on indefinitely for the next 5 years, to be honest with you. Remember, these target prices we have here are based on current earnings and sales expectations. My view is they're going to continue to grow over the years. And with that, I think so does the share price of Google. And if you look at the PE multiples we're using here, it's not excessive. We're not using an excessive one. If you look at Tesla, for example, at 70, 80 times earnings, we're nowhere near that stuff. So for me, Google is still attractively priced here. And I think those target prices are going to go up over a period of time. And there's still kind of 10% upside remaining in my view. So I would kind of stick with that one. But if there's other stuff there that's been stagnant, I'll give you an example. I'd see the S in my account there for a while. I ended up breaking even on it, and I just dumped it there because there's only 8% upside on it. So just to free up a bit of capital there, simple as, So, you might want to have a look at your stock portfolio. Check in with Equity Scan. These are getting updated daily, by the way. The analyst target prices are updated daily as well. They mightn't change every day, obviously, but if there is an analyst change, it's being reflected every day. So check in with Equity Scan to see your target price and see, do you want to actually hold on to that? Okay, folks, I'm going to leave it there unless you have any questions.
Thanks, Stephen.
All righty, guys. Have a good day.
Bye-bye.
Take care.
Cheers.
Bye-bye. Bye-bye.